Hi everyone, Fein here. Today's date is September 27th, 2012. In this short video, I will explain in a simple fashion what exactly the recent housing bubble was all about. You'll learn about what caused the bubble, who the major players were, what current politicians are doing to supposedly fix the problem, how it affects your money, and what the future will hold in store. 5 years after the largest crisis since the Depression, people still have no idea what they're talking about. They hear a catchy sound blip, they hear from somebody that has no idea what they're talking about, and they pass along this misinformation as fact. Some still blame the banks for making such outrageous loans and complex investment products, while others will blame the home borrowers for taking out loans that they just could not possibly pay for. The shocking truth is, absolutely neither one are to blame. They are the rational consequences of failed, central planned economic policies. They reacted in a quite reasonable manner given the situation laid out before them by the US government. Each individual will have their preference in either owning risky stocks or holding on to safe bonds, leasing a car or buying one, going to public school or paying extra for private. So why are Americans in agreement on owning a home rather than renting? Shouldn't they be just as split as all the other investments? From a very young age, Americans are taught it is in your best interest to buy a home. Unfortunately, this is not the case. Owning and renting each have their perks and their downsides. I'm not going to talk about this in this video. I'm just stating the facts. Americans are overwhelmingly taught to own a home. This is the very first foundation of a housing bubble. You must buy a home. The US government, through the FHA, HUD, Fannie Mae, and Freddie Mac, they guarantee home loans. What this means is anyone with savings to invest now can make a loan to a mortgage to a home buyer. No one with savings physically goes out and finds a willing home buyer. Our savings are stored in banks. Banks are intermediaries willing to give out loans to worthy borrowers. They do their homework. They calculate the risk of the borrower, and they decide whether or not to loan the money. There is a risk for all investments, and that risk is the risk of default. And homeowners are no different. If the bank can loan the money at an interest rate equal to or greater than the default rate, the bank will offer the loan. If the bank can loan out the interest rate for 7% and the risk of default is 5%, they'll do it and they'll keep the 2% profit. If the rate of default is 7% and they're only going to get 5% for the interest rate, they're not going to do it. So you let banks do what is in their best interest. However, with the US government guaranteeing all home loans, what this basically says is there is now no risk to the lender. Well, where did all that risk go? It didn't just disappear. The homeowner still has the risk of default. Well, in essence, the risk was transferred from the bank to the US government with that guarantee. At the end of the day, any debt or default by the US government is ultimately the US taxpayer's debt. So with this guarantee by the US government, they effectively transferred the risk from the bank to the taxpayer. Now, since the bank faces no risk, they'll extend a credit to anybody with a pulse. Banks all around the country were extending loans to homeowners everywhere and anywhere. This created an enormous growth in demand for homes. With increased demand comes increased prices. And don't forget, Alan Greenspan, the former president of the Federal Reserve, he lowered interest rates too low for too long, thus enticing borrowers to borrow even more. From the late 90s to the mid-2000s, homes across the country increased in value. Homeowners were extracting equity from their homes to purchase even more homes, thus increasing home values even further. In 2006, home prices began to fall. First, it was the subprime borrowers. These borrowers, they had huge amounts of risk due to either low or no income, very low credit score, or they didn't even look at the credit score. They were the first ones to default on their loans. As the subprime houses began to fall, the rest of the cards in the deck began to fall as well. Home prices overnight were dropping in value. Everyone across the country realized they amassed huge amounts of debt in buying homes that were not worth anywhere near what they paid for. Soon, a large percent of the population could no longer pay their mortgages on time. This caused huge losses to the banks. Banks were hemorrhaging money, huge losses every day. Investors in those firms were seeing declining stock prices. Institutions invested in those firms also saw huge losses. Downgrades appeared on those AAA investments overnight. Financial insurers were on the hook for these banks' losses. They insured them. Those financial insured companies were hemorrhaging losses, hundreds of millions, even billions of dollars, to pay for the bank's losses. The credit crunch came without warning. At this point, everyone knew the game was up. There was a housing and financial bubble, and the beginning of the end had begun. Prices on everything were falling like a stone. This was terrible for anyone who bought a home, and for the rich. They're the ones who were heavily invested in the market. However, these huge drops in prices were finally a relief for the poor and middle class. Finally, prices of energy, gas, food, clothing, medicine, everything, they were all falling to reasonable prices. This finally provided a time for opportunity for these people, the majority of the Americans. Unfortunately, the US government can never leave the markets alone. Just like they created this crisis, they were the first ones to criticize the bankers, the homeowners, and outright blamed capitalism. At this point, we shouldn't realize it was capitalism that failed. Capitalism would never have allowed this to happen, which is why there has never been a housing crisis anywhere to this extent in US history. This was a socialistic policy that went absolutely wrong, more than anyone could have possibly imagined. Immediately, the government tries to do what it does best: price controls. Prices are falling too low, too fast. Even though everyone prefers sales and loves lower prices, the US government swoops in to raise prices. Take a look at the Fed's first mandate of acceptable inflation. They aim for 2% inflation. They physically come out and say they want the prices of everything to rise by 2%. They want your wages to fall by 2% every year, year after year, for the future. The US government overnight tries to pass a bailout of $800 billion to bail out the banks and financial insurers with no strings attached, 100 cents of every dollar. They began huge programs to protect homeowners, loan mortgages. They try to modify everything, tax credits. Again, more socialism. Privatize everyone's gains, but socialize the losses. In essence, they transferred all the losses that the banks would have incurred over to the taxpayer. Then came QE1. QE1, quantitative easing, is money printing. Money printing leads to lower interest rates. With lower interest rates, the US dollar will give a lower return. This gives the incentive not to invest in America, nor not to invest in the US dollar. When the demand for the dollar worsens, the higher the prices go. So to keep it simple, lower interest rates equates to higher prices. In the infinite wisdom of the central economic planners, the Fed, they defend money printing by stating, with money printing, there will be more money for people to borrow. More money to borrow, they'll have more money to spend and to spur the economy. Again, they want to increase the debt and increase the debt economy. This same low interest rate of the Greenspan, which caused more borrowing and more spending and more debt, led to the housing bubble and recession to begin with. The Fed's QE1 failed to create any employment. This is seen by the huge unemployment rate, the amount of distressed workers, they can't find jobs, and ultimately they're taken out of the unemployment rate. Again, the US dollar increases with each program. The US debt currently is over $16 trillion. To equate that, every man, woman, and child in America has a $49,000 debt which they will have to pay, responsible of the US government. The Fed did QE2 and are currently doing QE3. They haven't put in any limit on QE3, and it's unlimited until they see the results they want. If QE1 and QE2 didn't work, third time's the charm? I don't think so. Unfortunately, all this money printing and debt cannot last forever. The Fed has stated they will keep interest rates near 0% until 2015. This originally was stated during QE1 to only last till 2013. With interest rates too low for too long, this creates bubbles just like it did in the 20s, setting up for the Great Depression, as well as the 1990s with the dot-com bubble, as again in the 2000s with the 2008 crash. Take a look at stocks and bonds. They are in a bubble. They have been rising from 2009 for no other reason than inflation and low interest rates. However, when inflation really starts to come, and we're not talking about the 2 or 3 or 4%, we're talking about double-digit inflation. The Fed will have no other choice. They will have to raise rates to combat inflation. And just like low interest rates fuel increasing prices, raising rates will do the opposite. They decrease prices. When the Fed raises rates, 2008 will happen all over again, and unfortunately it'll be much, much worse. I, for one, wish the government would leave the market alone, let capitalism work, let the market set interest rates and prices, and just let it stabilize by itself. They don't call the free market free for nothing. Hopefully you have learned a bit more about the housing crash. If you'd like to know anything more, please reply back with any questions. I will continually make some videos, more specifically with Social Security disaster, Medicare and Medicaid debacle, and the soon-to-be-seen student debt and municipal bond markets collapsing. Take care.